everyone. Welcome to yet another edition of Emkay Macro and Markets. Today we have with us the CEO of the Institutional Equities Desk at Emkay Global, Mr. Nirav Sheth. Hi Nirav, really great to have you here and looking forward to having this discussion with you. So Nirav, when we last met, things have changed a lot since then, right?
Of course.
There is still uncertainty globally, there's still volatility, but a lot of it has come off. And a lot of the dynamics that were sort of shaping markets late in 2022 may not be the case in 2023. So what do you think is going to be, or what are the few factors that are going to drive the sort of global narrative and global macro in 2023?
Right. So first of all, I think in my 25 years of career, I have never seen a period where there is no uncertainty, there is nothing to look forward to. That usually happens in what you call the parabolic move of the markets, right? Which is you're not worried about anything and you're so confident that the index goes up by some percentage points in a very short period of time. The good thing is that we had real issues with inflation the last time we spoke. I think that we have broadly passed that phase. Good inflation and any virtually collapsed. We are seeing significant moderation in services inflation. I, for one, have never been a strong believer in wage price spiral, but not that I'm an economist. But I think we passed that hump again. What we don't know now is that the lagged impact of monetary policy and the impact on the growth that is open to debate. So I think the markets will sort of play between expectations of moderation or a change in Fed's narrative, which is a U-turn, and the outlook on the growth. And I don't think that we'll get easy answers in the current year. That is the way I look at it. So we always have to keep in mind that Fed comes from a narrative which is very well documented, that you ease too fast in the last cycle and therefore prone to error and stuff like that. So that memory is very, very strong, and therefore I suspect that they could err in terms of trying to keep the monetary policy too tight rather than change, which means that you can have growth shocks more than inflation shocks, which means that it's probably not a very smooth ride for the equity markets globally and probably even in India.
Right. So as you said, 2023 will not be a smooth ride for global markets and for India. So then coming to India, of course, India was a relative outperformer last year, delivered sort of single-digit returns even when other countries were delivering negative returns in terms of the equity markets. So having said that, what do you think now in 2023 for the Indian markets? Because of course, there is this narrative going around that Indian markets are overvalued compared to peers and therefore there is a correction that could be impending. So what are your views on that, and in general, the view on the Indian markets for 2023?
So my sense is that what you are seeing is that we are seeing a derating that started, let's say, from the time you picked out in November 21, right? So assuming that with the benefit of hindsight, you are trading at 22 times forward way back then. Now we are trading at, assuming 1,000 rupees of EPS, which is consensus, we are trading at about 18 times, which is now a 5-year average. So you come back to a fairly valued territory. I suspect that we will probably be in this no man's territory, up 5%, down 5%, till the time the narrative on Fed pivot changes. I would be looking at that to try and figure out whether the markets move into the next level. And within that, I think then you start looking at sectors and stuff like that. But I suspect that you're not going to get return in the first half of the year, which also unfortunately is the market consensus, which worries me. That am I thinking like the market and can I go wrong? That's one. And the second important point is that again you hope that like Fed, we don't make policy mistakes. It could be in terms of what happens in the budget, if they try and tinker around with direct taxation. LTCG is what I'm worried about because that fundamentally impacts the value of the market. Or if we try and tag our monetary policy to what happens, what Fed does rather than what our Indian economy does, that's another risk that we see going forward. Outside that, I think, so that's the macro view, and my sense is that when I meet a lot of many companies, and when I meet so many companies and so many mid-cap companies, I get a complete different perspective in terms of their outlook on the growth and the opportunity. So, exports and China +1, Europe +1, PLI ecosystems. So some sort of contrasting views from macro and bottoms up, which means that, like I said, which means that you're not going to go anywhere till the time clarity emerges on the macro side.
Right. So, having said that, you're getting a contrasting view from the bottom-up sort of view of things. So, if we were to dive a little deeper into Indian markets and to go sort of maybe sectorally, even if you have stocks that you could recommend, or just in general, so what are then the stocks or the sectors to look out for in 2023? Could be positive or negative, and also of course keeping the budget in mind.
So I mean, the banks is 35% of the weight, probably 40% of the earnings, and then you got 15% weight, which is IT, and about 15% or something there about earnings. So you cannot have a conclusive view on the market till the time you don't get these sectors right. Fortunately, both these sectors seems okay, right? So, like I said, IT, the day Fed pivot happens, or if you try and preempt that, you can have a very sharp 10-15% move. I am fairly okay given the market positioning that in a year's time frame you can end up getting required rate of returns. Banks I'm very bullish on, but that obviously means that I'm bullish on underlying economy as well, because you cannot have a relative super outperformance of banks. I don't think that's healthy, because you cannot have a situation where you think banks are doing well but other sectors are not doing well, because this feeds on the industry itself. And then, like I said, building materials and auto ancillaries and autos, capital goods, construction companies. I think even consumer durables, they've taken a hit for such a long time. So I know what I don't want to be in. I won't be in super expensive, high P, the so-called BAP stocks. I'll avoid those. Outside that, I'm fairly okay. So I think there are enough ideas in the markets, at least on a bottom-up basis, for sure.
Okay, so that's it from our side. Please stay tuned and keep watching for more.